Today I'm with Reg Hoare, who is Managing Director at the Financial PR MHP. Reg, thanks so much for joining us.
Pleasure, Tamsin. Good to see you again.
So at the end of May last year, you gave us a fantastic presentation on investment trusts, which was titled The Panacea for Pandemics. So did investment trusts really turn out to be the panacea for pandemics? How did they perform?
They really did, actually, and they had a fantastic year, I'm glad to say. And hopefully lots of your viewers had plenty of investment trusts and were able to take advantage of that. According to the team at JP Morgan, 2020 saw the largest ever outperformance of the FTSE All-Share by investment trusts. And the Equity Investments Instruments Index produced a total return of 18%, which is a pretty stonking return, I think we'll agree, given the year that we had, the volatility, and in particular the period of sort of down in March. So a really good return. And we can see that actually illustrated on this slide quite effectively as to why that return was so good. And if we look back to May last year, actually there was a real opportunity, and part of that opportunity in terms of share price performance was the bounce back in the level of the discounts to net asset values that investment trusts are measured and valued by. And we can see in May last year that the discount had widened really quite starkly from sort of low single digits, 2, 3, 4%, around that sort of area, down to well over 10%. We then saw that by the end of the year, it had bounced back really quite dramatically, pretty much to the sort of levels which it had been seeing over the last sort of year to 18 months. And of course, that narrowing of the discount back to more normal levels really supercharged share prices in the second half of last year. So a typical investment trust benefited, therefore, not only from the underlying increase in the value of its portfolio, but it also benefited from that narrowing of the discount of sort of an average of around 10% or so.
Now, at the time, you did highlight the increase in NAV and the increase in yields. Did you yourself take advantage of it? Did you have spare cash on the side to take advantage?
Well, I didn't have spare cash. Unfortunately, I wish I did. But I was able to take advantage of it where sort of possible, and traded in and out of some stocks in order to take advantage of where I saw some opportunities. And actually, when we come on to my sort of portfolio list a little bit later, I'll be able to reveal the new buys during that period.
So when we spoke, you said you had about 65% of investment trusts, or 65% of your SIPP was invested in investment trusts. How did that perform last year?
Well, overall, it performed extremely well, as we can see from the slide. And actually, I suspect this graph and the progression of the graph probably is similar to many people's portfolios in terms of having that dramatic sell-off during March. And my low point, my SIPP, overall was down 35% and was looking pretty scary in terms of any optimism about retiring in the next 5 years or so. The good news is it had a really fantastic recovery from its low point, a very dramatic 75% recovery, and ended up the year as a whole up 14%. And you can see how it particularly had a really good spike up during that kind of November, December rally once we got the sort of, the positive news about the vaccines being approved. So overall, really pleased with that performance. And it was really very much driven by that substantial exposure to investment trusts.
So in that presentation, you highlighted some investment trusts, particularly those that had quite a lot of cash on the sidelines to invest at that time during the COVID crisis. How did they perform?
Well, they all performed extremely well, as we can see from the table, with quite a number of them producing returns, not just double-digit returns, but returns of sort of 50% plus. And I've listed those on the left, and I described them at the time as the cashed up and ready to go trusts. And particularly striking the performance of Herald, the tech investment trust run by Katie Potts, which has got a fantastic long-term track record, invests in a mix of US and UK. And then the other very striking one was the IPO group, which is more of a venture capital fund investing across technology and biotechnology. And again, a very striking move in their share price. Obviously, both of them helped by good news in the underlying portfolio companies, and that helped push the share prices up. And on the right, I've got some other stellar performers, which I've listed from my portfolio. And you can see, again, some really dramatic share price increases. And this is from May through to February, just for context.
And were they sector specific, or what was the reason for their outperformance?
I think there was probably a little bit of a sector effect. So if you look at those names, there is quite a bias to venture capital, technology, and private equity and small cap. In fact, all of those trusts on the left kind of fit into those categories. And within the kind of the private equity and VC trusts like IPO and Oakley, there's quite a high exposure to technology within those two. And then the stellar performers on the right, again, sort of broadly fit into that category. So, Augmentum FinTech, Draper Esprit, very much venture capital. EPE is private equity. And then obviously you've got smaller companies with the JP Morgan and Miton ones. So you can see that, yes, a little bit of a pattern there in terms of the kind of stellar performers. And my portfolio has been very biased towards a combination of kind of small cap, technology, private equity, VC type investment trusts.
And did any not perform as well as you were anticipating?
The answer to that is yes. One I'd mention was Allied Mines, which is essentially a kind of VC fund that's in runoff. It's got 3 remaining principal investments. And just quite recently, actually, it turns out that one of those 3 investments is not doing as well as expected. And they're going to have to significantly write down the valuation, as a result of which the share price has been quite disappointing lately. So that is always the risk, obviously, of any venture capital specialist investment trusts, is that if one big investment does go sour, it can impact the portfolio sort of more dramatically than, should we say, a more generalist trust, which might have a much wider spread of investments. So it's there's a bit more risk involved, and Allied Mines was probably the most disappointing of the lot. The other one that was a big disappointment was Crystal Amber, and that may be a familiar name to those that were followers of Hurricane Energy, which obviously was a disappointment in itself. And Crystal Amber made a big bet on Hurricane Energy, and obviously, unfortunately, it turned out to not be a successful bet. And given that Crystal Amber is a very concentrated portfolio, Hurricane at various points over the last year or two has represented somewhere between a quarter and a third of its asset value. Clearly, when Hurricane shares collapsed, it had a very big corresponding impact on the Crystal Amber portfolio. So that was a big underperformer during the year. As the sort of latterly, they had a little bit of recovery because they've had a big holding in De La Rue, which has obviously been a fantastic recovery stock. So I'm sort of more hopeful that they've turned the corner now, and we're going to see a better performance in 2021.
So you did cover off your criteria and how you selected the investment trusts largely by sector, and that was private equity or small cap or technology, which have all done fantastically well. So what did you do? Did you top slice? Are you still staying in those sectors? What have you been up to?
So very much still staying in those sectors, because I see those as kind of long-term high growth sectors, which I think will outperform, relative to the more kind of pedestrian areas of the economy and the market. So I've very much retained the majority of those holdings. Now, looking at this slide, I've color-coded where I've either top-sliced or where I've created new holdings. And the ones in red are ones that I've top-sliced. And I've top-sliced them largely because the share price has performed so significantly well, or because the discount NAV closed to such an extent that they no longer represented good value to me. And a good example of that might be JP Morgan smaller companies, for example. And also I became a little bit nervous of those trusts that employ gearing, obviously as these are companies, with a normal public limited company structure, they're able to borrow money from the banks in order to effectively gear the portfolio up. Now, JPM smaller companies, for example, is now around 10% geared. And that's fine, I think, when going into the autumn rally. That was a great position to be because it obviously enhances the performance of the portfolio if it's effectively 110% invested. But if one is slightly risk averse now, then clearly one might feel uncomfortable with it being so highly geared if there was a big sell-off, or perhaps concerns around, a bubble in the US hitting the markets, then the fall in the share price would be exaggerated. So that was one I took profits on. I sold out of Electra completely. That was the only holding that I've sort of sold out of 100%. And the reason I did that was that the share price had a good run. It had closed the gap to the NAV. Electra, as people may know, is in runoff. It's really only got two principal remaining investments. Both of those investments are in retail and leisure. And my instinct is that the two particular brands involved, Hotter Shoes and TGI Fridays, will be two brands that will have been impacted perhaps more than others in terms of their survival and their value as and when Electra can sell them. So I thought it was right to sell out of Electra. Then in yellow, highlighted in yellow, are my new positions that I bought during the year. And actually the first one of those that I got involved with was River and Mercantile, UK microcap, which is a not dissimilar concept to the Miton UK microcap and the Downing strategic microcap. I investing in genuinely small companies, the sort of sub 100 million. And that was lurking on, I think it was about a 35% discount in June when I first took a position. And I couldn't really see why, other than it was just down to pure sentiment and, the trust being sort of forgotten about. And it really took advantage of the rally in share prices during the rest of the year. It was well positioned in some good microcap stocks, and it's performed incredibly strongly. The share price has broadly gone up from sort of the 140s to the 220s over that period of time. So really pleasing performer. I also have been keeping an eye on Chrysalis, which is the former Merian Chrysalis, which has rebranded itself, and that's a venture capital trust which is best known for having a big stake in the HUT Group. And of course the HUT Group IPO'd, and it turned out that was a real opportunity to buy the shares around that time at about 150p, and they're now up in the 190s, and that's been a really good performer as well. The most recent one I've been dabbling in is Schroder UK Public Private, which of course is the former Woodford Patient Capital, and that's now looking like it's in a very interesting position, given that it's had a great success with one particular investment, which is now sold at a significant premium to the balance sheet value. They've also sold a portfolio of the smaller investments to a third party to raise more cash. They've renegotiated their banking arrangements. So they're now in a much, much stronger position where they're not going to be forced to sell anything off in order to keep the trust going. and they can sit tight on the remaining investments until those investments mature. And it's clear from the public statements from the managers of the fund that they're very positive about the remaining investments, the prospects of those remaining investments. And as a reminder, of course, it's a biotech, related fund. And then the bottom one I just mentioned, Miton Global Opportunities, which is a really interesting fund of funds, actually. So it invests in other investment trusts where the manager thinks that those investment trusts are looking very undervalued, and where they think there might be a catalyst for an improvement in performance. And so there's been a sort of double benefit in a sense. The trust itself has performed well, it's been in the right investments, and the underlying investments have done exactly as the manager was hoping. They performed themselves much better. The discounts have narrowed. So that's been a good one to be in as well.
So if you had to pick just one investment trust that's going to outperform for 2021, out of all of those, which one would you pick?
Well, that's a very difficult question indeed. And I've listed, it's a bit of a cop-out, I've listed actually about 10, I think, on this slide in terms of ideas. And I think it sort of one slightly pays one's money and takes one's choice in terms of which area of the market that one is most interested in. And it may be that, as you can see from that list, there's quite a lot of kind of VC, PE type funds I've included. There's several that are in runoff, where effectively I'm looking for a good result from the runoff. And it depends, I think, also a little bit in terms of how risk averse or risk on investors are. I think if I had to choose one which kind of was a balance of all of those things, then I'd probably say Mercia Asset Management. So Mercia started life as a technology venture capital fund. It's evolved into a sort of hybrid of being an asset manager, hence changing its name to Mercia Asset Management. So it now is an asset manager of a number of venture capital trusts, as well as investing in the underlying investments that it is managing in those portfolios. So you get the double benefit of the earnings from the fund management business, as well as the potential upside from the underlying investments. And given that it's broadly been very much focused in on that sort of technology sector, I still see some quite exciting potential upsides from some of the underlying investments, as well as kind of good underlying growth in the asset management business. So I think that's the one that I'd have as a kind of what I might call a core holding, that I think one can buy, and it's going to do well, and there's potential upsides from good outcomes. Some of the other ones are a bit more binary, in terms of the manager getting a good outcome or getting lucky, or the market suddenly alighting upon that individual trust and saying that the opportunity is there. Macau Property Opportunities, for example, is probably the most speculative of those. And for those that don't know it, it's basically a real estate investment trust that's invested in properties in Macau, as the name of the trust implies, and it's in runoff. So they've agreed that they're basically selling the portfolio down, and they're going to return funds to shareholders. Now, it's on a massive discount of 57%, and the reason it's on such a big discount is obviously people are nervous about the state of the Macau economy, because it's been heavily locked down over the last year. And as you probably are aware, it's highly reliant on Chinese visitors to its casinos. In short, that's its core business model. And obviously the buyers of property in Macau are principally going to be people, related to that gambling industry. So at the moment, the market's a little bit twitchy, a little bit nervous about how that might play out. But I'm beginning to get more confident that with the vaccines, lockdowns easing, one could see a way for Macau and its gambling industry to come back to growth and recovery. And that in turn should see its property market recover, and therefore enable the managers to sell off those remaining properties. And interestingly, the few sales they have achieved during 2020, they have achieved at slightly above the balance sheet values. So that does show that it's had a very conservative valuation, and therefore that the risks are on the upside than the downside. So that's my kind of speculative pick. Mercia, my more conservative one.
And very briefly, what's your feel for the markets for the rest of this year?
I'm positive. I was about to say I'm bullish. I genuinely am. I think the UK is uniquely positioned, and that's why I'm bullish. I mean, I think if you look globally, there are more risks because clearly the US, there are some arguments around whether or not the market there has got very extended, and clearly some of the reason the UK market has been not performing that strongly in the last couple of weeks is because of that sort of US sort of effect. But I think the UK is very uniquely positioned because firstly, it looks very cheap on any international measures. Secondly, the reasons why it's cheap have broadly now been removed, which was kind of principally Brexit, frankly. And the removal of that uncertainty, I think, has unlocked the potential for investors to come back to the UK. And the reality is that global investors and indeed UK domiciled investors were very underweight the UK over the last few years. So it would only need for a bow wave of investors to go, right, I'm moving from underweight to neutral. They don't even have to go overweight the UK. Just going back to neutral would result in significant flows into the UK markets. The other key point is that the UK is overexposed to value stocks because of the very large proportion of sectors like oil and gas, natural resources, telecoms, utilities, banks, insurance companies in the FTSE 100. So it is, it's a bit of a value play, and there is no doubt that fund managers this year are focused much more on value and recovery stocks than they are necessarily on growth stocks. Whereas, the last few years, it's been very much about growth. But another reason I'm bullish on the UK is that I think that there's going to be a lot of M&A activity this year and going forward. And I think we've seen a little hint of that last year. The UK does remain a very attractive market for both private equity buyers and also international buyers. And, both of those categories are cashed up. Our market is easy to access for them, and there are lots of really interesting and exciting companies for them to consider buying. And I think domestic M&A also will be strong because the strong companies that have survived the pandemic broadly are in a better position going forward than they were in the past because they're sitting on strong balance sheets, access to capital, etc. So I think M&A is going to be an important driver of potential returns in 2021. And lastly but not leastly, I think the UK has been at the forefront of the vaccination programs globally. It's been one of the great success stories, as we know, and it means we're going to come out of this pandemic quicker and probably in better shape than many of our European cousins in particular. And I think international investors will look at that and they'll give us, brownie points for that achievement. So that also gives me encouragement to be positive to bullish about the UK for 2021.
Good to hear. Reg, thank you very, very much indeed.
My pleasure, and great to talk to you and to everybody else.
And to everyone listening, there are more interviews like this at piworld.co.uk. Thanks for joining us and stay well.